Right, Antoine Lesne joins us, head of SPDR ETF Strategy and Research, EMEA, State Street Global Advisors. Antoine, just looking at some of your notes as well, regardless of what to expect for the earnings season, we're asking viewers to pay 50% higher than the 10-year average for US stocks if they want to buy them. Do you think they should buy them with that in mind, or do you think they should hold off?
It's the question of valuation is always a tough one when you're looking to buy things. Obviously, you're looking at 10-year average. You're also taking back some of the recoveries that had happened after the great financial crisis. So if you put that in perspective, maybe you should look at a 5-year average. The numbers look a little bit better. So the expensiveness of today's market may not look at as high as versus a 10-year. I think you're more looking at, still a good 30-35% more than the 5-year average. But it's, there's a question of valuation. There's a question also of where you can put your money at work in this environment. And that's going to be the key question. So maybe be a bit more differentiated, or look for what is in your overall S&P benchmark, if you want, or S&P 500 benchmark.
All right, okay. I'm going to just disseminate your last answer before I ask the next question. So what you were saying there is don't look at the 10-year average, because that's got the bad bits in as well. Only look at the 10-year average compared with the frothy bits, so that today's frothy valuations don't look as frothy compared with the other frothy bits when you take out the bad bits, yeah?
That's kind of the thing that
I thought as much.
Message that you want to look at. I mean, I'm not saying it's not highly valued, but there's a dimension of looking at it into the context.
Okay, all right, let's move on then. Anything in the bond world to get excited about? I see inflation-linked SPDR ETFs getting a little bit of traction.
I think overall, and we're about to release our what we call our bond compass in the next week. But what we've seen is it's been the first time since, I would say, just counting back at least 5 quarters, that we've started to see not only flows into ETFs, which can move more quickly, but we've also seen long-term institutional investors starting to look at US inflation-linked bonds, so TIPS as we call them, and that's clearly on the back of maybe interesting valuations, because break-evens had fallen massively after the March episode of knee-jerk reaction to the COVID crisis, and it's coming back. And obviously, we see some relatively good numbers, or relatively reassuring numbers on the inflation spectrum in the US. So I'm not going to say the same thing for Europe or for the Eurozone in any case. But interesting move at the moment. The question is, has it run its course? Has it run its course yet? As we see that our real-time indicators of inflation are showing that yes, we're out of deflation, but we're not going into very strong inflation going forward. So there's some manageable element to take into this context.